Hello, everybody, and welcome to the Alphabet. This is the first video in a series that we are going to be doing deep diving into earnings and so much more. We're going to be targeting this for beginners, but there's a ton of content that's going to apply to everybody coming on this channel. I'm God from Wolf Financial. I'm here with Brad from Stock Market Nerd, Evan from Stock Market News. We're going to get right into things, discovering where you can actually find this data. I'm going to turn it over to Evan to get us started.
Yeah, so we are trying to take you from a beginner, this is your first time looking at an earnings report, going to be an advanced investor, being able to digest and understand the earnings. So starting from the top, you have to be able to know when the earnings are going to be coming, and also you have to know what is expected. I think if I'm going to start here, one of the biggest rules, and if you were a beginner, one of the biggest takeaways you should have from this video is that the numbers themselves are not what's going to move the stock or what's important. It's how they compare to analyst expectations. But we will dig more into that. We are looking at an earnings calendar right now from Savvy Trader, but there are a bunch of these around, and there's also a lot of really great tools to help you find expectations. Brad, what are some of your favorite?
Yeah, Savvy Trader is a go-to. The Transcript is another great one. And then Earnings Whisper is a great one to find out when these reports are actually happening. And then Evan, a really important point about estimates and guidance and that being so important for the actual reactions of the stocks. There are two resources that I lean heavily on to kind of scrape estimates and to use them when I'm forming opinions. One would be Tikr.com, TIKR.com, and the other would be Koyfin.com, KOYFIN.com. They have some pretty overlapping features. They're somewhat similar, but Koyfin has a really pretty graphic that shows how estimates are trending over time, so that if they're getting higher or lower, if analysts are expecting more or less. And then Tikr really gives you in-depth details with more financial metrics and more aggregated estimates than you can really find anywhere else besides maybe a Bloomberg terminal for 30 grand a year, which is steep.
Awesome. So now we know when the report is going to be. We also know what to expect. Now, how do we go in and find that? So you are going to type in every single company that is public has an investor relations page. If you search into Google, we are using NVIDIA as the example here. And if you search into Google, just NVIDIA investor relations, you could take out NVIDIA for Apple, Google, Microsoft, Apple, and they all have their own investor relations page. On this page, you will find all the earnings, but there's a lot of other stuff, news releases. There are whenever the CEOs are talking at conferences and a lot of other stuff. So once you click into that investor relations page, for our purposes here, we will look over to where the earnings are. And if you look at the quarterly results, there are a couple different things here. There is a webcast, which you can go in and hear the CEO, in this case is Jensen Huang, and other management speaking. You can have the 10Q, which is a little bit more of an advanced version, a little bit more thorough than the press release. So we will talk about that one a little bit later. But for our focus here, it's generally going to be the press release. Sometimes a company, the press release will just say, hey, go in and look at our shareholder letter, and then it's actually in the shareholder letter. But 90% of the time, it is in the press release, the numbers that we are looking for. And once you click into that PR, you are going to find a key highlights up at the top. Generally, this is where the biggest stuff are, but you have to keep in mind that this is the company putting into this together. So they're going to have the top line and bottom line, the revenue and net income and EPS there. But they're also going to really talk about the highlights, the positives of the quarter, the stuff that they want you to see. If there's any really kind of anything crazy going on that is affecting the quarter, the numbers, negatively, they are going to talk about it there. So this is a really important place to look. Brad, I would love to know how you use the key highlights and how much time you spend here on the reports.
Yeah, so press releases are a great way for very high level, quickly learning how a quarter actually went. So they're all different. All of them are a little unique in how they're actually structured, but typically there's going to be a series of bullet points covering demand, covering profitability. Then there's going to be a paragraph or two from the CEO saying this went really well, or this didn't go so well, and we overcame this macro obstacle, or we didn't overcome this macro obstacle. And then there's going to be a CFO blurb talking about financial performance. And then as you scroll down, so at the bottom of the press release, there's going to be something called a guidance section. So Evan alluded to this before, and Gav, if you could kindly go to the next slide. The guidance section is going to take you through forward-looking estimates. So we have to remember that earnings reports are a look in the rear view. It's 3 months ago, 2 months ago, 1 month ago, what has already happened. And these estimates are management's way of conveying to us how are the next 3 months going to go. And why is that so needle moving to the stock is because, well, if you're saying that revenue is going to grow by 10% and analysts wanted it to grow by 30%, that's not going to be very well received. So there's a little bit of nuance in there in that earnings price reactions are sort of somewhat of a crapshoot. They're very related to sentiment. They're very related to how a stock price moved over the last 3 months. So if a stock price doubled, that inherently means the expectations are maybe a bit higher for beating by a wider margin. But really, all in all, what you need to know from a press release is it going to be those few bullet points, a few paragraphs, and then the outlook at the bottom.
Awesome. Yeah. So if you're a lot of the times looking at numbers and you see EPS beat, revenue beat, which are both top and bottom line there, a lot of times the stock will go down and people are wondering what is happening here. I'm going to say 9 times out of 10, but it's not always that simple, maybe 8 times or whatever. It's that forward guidance, which just is slightly below expectations or slightly above expectations. And that can really change the numbers. You have any more thoughts on this, Brad, before we look at the financial statements?
Yeah, super quick point that I want to make. So this is a long-term investing YouTube channel, and we're going to cover long-term investing concepts. So if something sells off and maybe 20%, and that's always scary because maybe revenue grew by 24.5% and analysts wanted it to grow by 24.7%, it's really important to just focus on the fundamental quality of these numbers, maybe versus expectations. Now, it's one thing if they miss by just a massive margin, but if they are missing by razor thin margins and maybe the company was priced for perfection, it's a lot more important how revenue is trending, how net income is trending, how EBIT is trending, which I'll cover in the next slide, versus how the stock price reacted 30 minutes after an earnings report.
I agree with that. And, Brad, I did start out the video saying that analyst expectations are really the biggest thing for how a stock is going to move, and that 100% is how the numbers compare to those analyst expectations. But as you were pointing there, that's more in the short term. When we think about the long term, it's the trends and it's where the numbers are going over time. You want to see that growth. But Wolf, do you have any thoughts on anything we've talked about so far before we go into the financial statements?
Very quick note on the analyst expectations, as well as from the company side. One of the key things which I do like to look for is earnings revisions as well, and whether the company is revising up, revising down, how many times they did that beforehand and that was done. That can be just something to keep an eye on. Sometimes if a company is doing a number of revenue down revisions or something along those lines, or you see that coming from analysts, right, that can be a bad thing to see. And sometimes they'll do it 20, 30 times, right, leading up to it. I use Seeking Alpha to keep track of this, but just wanted to point that out as something to keep an eye on.
Awesome. Let's get right into these financial statements. We're going to dig into these more. Each one of them, I'll give you guys the full in-depth so you can understand really every single nuance there. But we just want to start here, just basically telling you what are these statements, what are they telling you, and just what are the 1 or 2 key numbers and key metrics that we are looking here. So Brad, tell me more about the income statement.
Yeah, for sure. And I'm going to try my absolute best not to go full nerd mode here. So I'm going to keep it very high level, and we're going to, again, ramp complexity over time. But I want to pull a few highlights from each income statement, and really starting with starting with the financial statements and the income statement first. But what is the income statement? And it's an idea or a view into how a company performed over a certain period of time. How did demand go? What were cost buckets looking like? What was profitability looking like? That is what net income is telling us. It'll give you a 3-month view. Sometimes it'll give you a 12-month view if a company is reporting their fourth quarter results. But getting into the actual numbers at the very top, and it's why this metric is called the top line, we have revenue. So how much revenue and how much demand a company collected over time. At the very bottom, so intuitively named the bottom line, we have something called net income. So when you subtract all input costs and operating costs and non-operating costs, what are you left with? What are shareholders left with? And that allows us, when you divide by share count, to get something called EPS, or earnings per share, which is just an extremely important and an extremely relevant metric for valuing companies and seeing how their value is going to trend over time. But really quickly, in the middle of the income statement, there's something called income from operations. And what does that mean? You're going to see all over Twitter, all over YouTube, all over these social media sites, when people are saying, here's what numbers are, you're going to see 4 letters, EBIT, earnings before interest and taxes. That is synonymous with income from operations. And that is arguably the single most important metric for gauging operating profitability. So we have revenue on the very top, we have net income on the very bottom, and we have income from operations, or EBIT, EBIT, in the middle.
Awesome. If you are enjoying this video and you want to see more stuff like this, make sure you're giving it a like, subscribe to the YouTube channel. This is only the start of this series. This is only the start of this YouTube channel. We have so much more coming. Awesome. Brad, I appreciate that explanation there. Let's dig into the balance sheet a little bit more. Tell me more some of the top level stuff of what we find on this statement and one of the two key things you look at.
Yeah, and I appreciate you too, Stock Market News. But focusing on the balance sheet and not turning this into a love affair, they're again pulling just a few highlights from these financial statements, and again going further into it, a lot further into it over time, but starting with just the high level concepts. What does a balance sheet tell you? It gives you a snapshot of the asset and liability basis of a company at a certain period of time, a static period of time, a snapshot again. So while the income statement is a period of time, the balance sheet is just a single point of view, a single second, split second, where you can lock it in and say, here's the asset base, here's the liability base, here's what it looks like. And from those assets and liabilities, the most important thing to look at on the asset side is something called cash and equivalents. So cash equivalents can be federal securities like T-bills or something like that, just very highly liquid, extremely low risk securities that can be sold for cash in a split second whenever a company wants to. And that's why they can lump it into that cash and cash equivalents bucket into just one single line. But going towards liabilities, and also very important, there's two different kinds of debt that a company can incur, and it's based on time frame. So there's more nuance, but for the sake of this episode, just two different kinds of debt. One would be long-term debt, and that's debt that's not due in the next 12 months. And another would be short-term debt, which is also called current debt. And that is, as you may expect, is due in the next 12 months and is a great way to view the company's interest and principal liabilities and how they're going to take away from operating profitability, how they're going to take away from the available cash a company has to invest in growth or research or buying another company, things like that. Now, on the balance sheet, and this is actually portrayed on the income statement, but it's more relevant to the balance sheet, so it does belong in conversation on this slide. You can see how something called basic share count and something called diluted share count are trending over time. And in dilution, as profit per share, so that numerator is total share count, and as that numerator grows more and more, it eats away from the value that profit per share compounding over time really should be delivering to shareholders. So we'll get a lot further into the stock comp accounting debate over time. But for now, just really keep an eye on. And for NVIDIA, you can see the share count's actually shrinking because they're repurchasing shares rather than printing just more and more shares. But for now, balance sheet, you have cash on the asset side, which is extremely important. You have short and long-term debt on the liability side, which is important. And how share count is growing over time and eating into profit compounding and the value that should be providing, also related to the balance sheet, also very important.
Awesome. One thing we did skip over, I very briefly want to hit it. Look at the dates on the top. Sometimes companies will surprise you, and like the nearest date will be on the right. Sometimes it'll be on the left. Just always know what time period you are looking for. A lot of times companies will also add 3-month periods or 6-month, 12-month, or something like that. So always check the top for what date you are looking at and time period. But Brad, really do appreciate that. Let's keep it moving over to the last of the financial statements we will be looking at. That's the cash flow statement.
Yeah, cash flow statement. So very related to that stock comp debate that we're going to cover. For now, we're going to talk about how that connects to the income statement and key metrics to pull from the cash flow statement. So as you can see, at the very top of this statement, we actually start with what we ended at the very bottom of the income statement. We start with net income. And why is this? It's because cash flow, it's called cash flow from operations. And then you subtract something called capital expenditures to get free cash flow. That's actually telling you what the cash that's coming in the door or coming out of the door and feeding the cash pile on the balance sheet. Now, net income includes a lot of what's called non-cash expenses. So things that don't actually impact the cash pile, but are treated as expenses based on just general accounting rules that exist in the United States. It's called GAAP, or generally accepted accounting principles. So just very important to understand that the cash flow statement is taking the profitability view that we got from the income statement and turning that into a perfect view of cash in the door or cash out of the door. So from net income, you make a series of adjustments for costs that you already incurred or benefits that you assumed on the income statement to arrive at that cash flow from operations, which is how much cash your day-to-day work actually brought in a certain period of time. And again, from there, we take cash flow of operations and we subtract something called capital expenditures. Now, what is a capital expenditure? It's a cost spent on a long-term, a big project is a good way to think about it. So Meta Platforms is a wonderful example for CapEx and how they're building all this data center capacity and computing footprint. Those costs to build these massive warehouses that are actually going to store compute capacity are considered CapEx. And we do have to subtract that from cash flow from operations to get free cash flow, which is just an extremely important profit metric for these companies to track.
Fantastic, Brad. This has been a great video. We wanted this to kind of be, if this is your first time looking at an earnings report, we want you to be able to look at it and say, I at least kind of know what's happening here. And we want to take you, and the future videos in this playlist will help you understand it fully and be able to make your own decisions in the moment. And we are really looking forward to putting out all that content. But Brad, I know we wanted to talk a little bit about the psychology around the earnings. I know we talked about that a little bit earlier with if sometimes they miss by half a percentage point and the stock goes down 20%, it can lead you to make some mistakes, but the company itself there's not that much changing under the hood. They missed it by a tiny bit. I would love to get your thoughts kind of around the psychology of earnings. There's a lot of big moves and it can be stressful. It can also be really great, but I'd love to hear your thoughts around that.
Yeah, and I mean, earnings season, if you own a portfolio of a few dozen companies, there's inevitably going to be a stinker, or if even if the company reported good earnings, good numbers, there's inevitably going to be that 15-20% sell-off that that kind of is anxiety provoking and is nerve wracking. So really what I'm looking at, and I'll use a few examples here. So starting with a company like Shopify, it went in a pretty straight line from about 29 bucks a share to $62 a share or 60 bucks a share, something like that, in the span of 3 months. So when that happens, and we covered it really briefly at the beginning, that innately really builds up the expectations and raises the bar for just having an incredible quarter. And we're using NVIDIA as an example here but it's really interesting to note that NVIDIA did the exact same thing. It's just that it guided to $11 billion in revenue, and it was supposed to guide to $7 billion in revenue, which is just completely bonkers, which is why it continued to have some fun as a share price. So all of that is to say that price action leading into the report matters, sentiment matters, market attitude matters. But the thing that matters absolutely the most by far for us long-term investors zooming out over several years is how the numbers actually look. So if they missed net income by 1%, if they missed revenue by 1%, that matters a lot less to me versus if the runway is intact, if market share is growing, if their competitive edge is sharpening. That is really what matters. But I mean, with that said, I'm going to use another example of a company called Upstart, which has been, just bluntly speaking, my worst investment to date as an individual investor. When they're missing their revenue guidance and when they're missing their EPS guidance by 60 or 70%, that's a different story versus a 1% or 2% miss on key metrics.
Well done there, Brad. That was a fantastic walkthrough of all the statements, plus the side that people don't see, right? Which is how investors react emotionally. And I'm really looking forward to doing more videos, deep diving that in the future. We're going to wrap this one up here. Thank you so much to everyone that tuned into this first video. If you made it this far to the end of the video, comment below which one of us is your favorite. I'm just kidding. Comment below stocks which you want us to go ahead and do deep dives on in the future on this channel, or just say something nice and we'll try to respond to you. We look forward to seeing you all on Twitter. Brad, any final comments?
No, thanks for tuning in. Have a wonderful day, everybody.
Evan?
I'm excited for what this channel will become. I'm excited for everybody to see it. Shout out to everybody who, I think it was like 600 people who subscribed to this channel already before we even posted this first video. And I'm really looking forward to looking back on this video in a couple years from now, laughing at the quality, laughing at us kind of on here. And I'm excited to start something big. So if you are still literally listening to this to that last second, me rambling here at the end, you are a true fan. We really do appreciate you. And this channel will be a really big thing.
We look forward to talk to everybody soon.